Everyone, welcome back to the TraderLion channel. My name is Richard and I'm with Ross Haber. And today we're continuing our America's Greatest Company series, and we're going to be talking about one of the strongest IPOs ever, Google. So everybody knows really the fundamental story. It had a dominant search engine really taking up that market share. But there's a few key points in terms of the fundamentals that really stand out to me. One of them, as O'Neill points out here, Goldman Sachs was one of the key underwriters, which we often find in great stocks and IPOs. The underwriter really matters. If it's a quality bank, that just is kind of one more check mark that you like to see. Then if we go down to the fundamental earnings and sales, you can really see how Google really jumps off the page. And down here, you can see as well, O'Neill points out that before the initial buy point, the last 3-quarter earnings were fantastic, triple digits pretty much. Last 4 quarters of sales were 173%, 162%, 125%, not too bad. Return to equity in 2003 was 87.8%. That's fantastic. And pre-tax margins as well were very strong at 39.3%. So in terms of fundamentals, it had the disruptive technology, it had the earnings, it had the sales. So now from this point, all we have to do is find a proper buy point and make sure that we hold this potential big winner. So Ross, I'll hand it off to you. And because the chart in this document is a little bit low quality, we're going to go over to MarketSmith to start off with and take a look at the weekly chart and then really zero in on the daily and talk about IPO bases, which Google is a great example of.
So looking at the weekly chart here over on MarketSmith, so we can see things a little bit more clearly. We're looking at the very beginning here, Google's IPO base, and we'll point out right from the get-go, like Richard said, this is one of the stronger IPOs out there. The large, over 90% of IPO bases are right around there. Will typically undercut the low of the IPO before going anywhere. So the fact that Google not held its IPO low and broke out is telling you something, not to mention, if you look up here at the S&P 500, Google was actually moving up powerfully into a sell-off in the general market. Here, as you've got the S&P 500 making a low, Google just base built and held up tight. And, ultimately, that's why you'll constantly hear saying that, corrections in the general market are the breeding ground for your new opportunities. And we're constantly making relative strength lists. That's how, so even if you had missed Google's IPO breakout here and didn't start paying attention until this breakout up here, it's not the end of the world. And you're able to, again, this is, one of those big volume liquid stocks that you can buy into strength. And obviously back in this time frame, 04, 05, 06, the volatility isn't as wild and crazy as you see it today. But anyway, so we've got a super powerful IPO U-turn breakout. We hold the lows, and I'll point out one more thing. If I'm not mistaken, Google actually came to market about $10. The low of this chart is about $10 higher than the actual IPO price of Google. So this actually would look, well, that's an arrow, but would actually look a little bit more like a flag than it currently does. Irrespective, we've got the super powerful breakout. You see, so let me point out, as it comes in towards its lows but holds, look at that major dry up in volume. And as we come up the right side here, volume picks up in a big way. We've got the breakout, which, as we discussed, this powerful up move actually occurred as the S&P 500 and general market was quite heavy in selling off. And as the market was forming its bottom, that's where Google ultimately formed its first, what turns out to be a base on base. We'll see here, we've got, we've got a cup with no handle. You can see it probably gets a little bit wedgy here. Yep. Volume dries up, but that's not a proper handle. So this little breakout attempt right here ultimately fails. It tries again and doesn't work. So you wind up with, base on base action here before you get an actual breakout again. Let me clear up.
Yeah,
please, Rich. Yes, please fill me in. Fill it in.
Yeah, I was just going to say, look at how it's like 4 weeks tight at the bottom there. If you can click that or like put your mouse over that, right at the bottom of the base, volume's drying up, price is tightening. So that's what you want to be looking at. You can see as the market is actually pulling back here, it's already tightening up and getting ready for another move. So these are the things you want to be keying in on as you're looking for relative strength. Look at the weekly charts, look for tight weekly closes. That's a sign of accumulation at the bottom of that base.
Absolutely. And then of course, look just on a relative basis, look at that I mean, there's no high talk about the elephant getting into the bath. I mean, that's big institutions loading up on that stock, and there's just no way they can hide it at that point. So that's telling you something. So again, we've got another clean breakout. That one surprisingly comes rather quickly up off its 50-day average and from the lower half of its base. I mean, to be quite honest with you, I would consider this more of, what we discuss at TraderLion is consolidation pivots versus actual proper base breakout pivots. In general, we'll consider anything in the lower half of the base a consolidation pivot. But the fact that this thing just, let's call it 7 or 8 times out of 10, when you get especially in today's market with the volatility, when you see this sort of thing without any consolidation and you go straight up the highs from the lower half of a base, making this early entry area here, the consolidation pivot here is your proper base breakout. And you can see you just take off and run despite not ever having any sort of consolidation here. It never rests. And I mean, yes, it's improper. However, I guess this is also you get an idea of how strong this stock is here because it refuses to even be bothered by the market. So, talk about that basketball underwater when the pressure finally comes off, out of this, base on base structure, that's telling you that that's a big sign of power. And, I don't always take you've got to try and not, it's a semantics thing, right? There's so many cases, where distribution, you've just got to use a little logic and intuition sometimes. And even though something might not be exactly proper, you want to look at something within its particular, scenario, what the market's doing, the group is doing, what it did prior, all of that sort of thing. So in any event, this is telling you that, I mean, you can see the volume, Ray talks about having the biggest, I think this is a mark of biggest volume ever, if I'm not mistaken, this teardropped orange here. So again, this thing is screaming. And so we've got your IPO breakout. Here's our first stage base. Here's stage 2, which is still considered early stage. Now we're working on a stage 3 base, which I'd say is considered later stage, definitely has a higher failure rate than stage 1 or stage 2, but is not as failure prone as stage 4. But this is where we start to pay close attention to what's actually going on in the base. You've got, looking at the actual price volume action and letting that guide your decisions more than just a basic rule. Well, hey, it's stage 3, it's probably going to fail. Yes, it's more failure prone, but you also have to keep in mind how much strength Google has been showing, since its IPO, the run up during being heavy on the market, the massive breakout on huge volume here without ever taking a rest, that sort of thing. So as you're seeing it, even though this is a stage 3 base, it's super tight. You can see it possesses many of the same characteristics as the prior base on base, like Richard was showing. We tighten up in and around a key moving average. As volume dries off, we've got that same sort of action going again. Right. You'll see this. So our red line here is our 10-week moving average, which is the equivalent of our 50-day. This pink line is a 13-week moving average, which would be close to our equivalent of the 65-day exponential. From weekly to daily, we're going to lose a little bit anyway. That it's going to make little difference, but that still gives you a good visual representation of where that average would be. I don't think it's something your eyes are going to be able to really separate at this scale on a weekly chart anyway. So again, we've got the big dry up in volume, the tight action in and around its key moving averages. And then once again, when the institutions are ready to, they can't really hide when it's time to buy. and accumulation is underway. And sure enough, we break, we start to without even looking back, you can see these are well above average volume. How much we don't know, and much bigger than any of the prior weeks going back many weeks. Now we're coming up to, we've got a solid run up here out of that third stage base, which is nice and tight. So now we're on a fourth stage base, which is much, your chances of
a big run are diminished. There's a higher probability of failing. Yeah,
exactly. So now you're approaching late stage, and you want to start watching how is this base forming. It's you've got the odds working against you, and sure enough, it becomes a little more wide and loose in this area than in, as you can, the corrections, off the highs here into this base, and the same thing here. You can see how tight we are. So we start to get a little bit wide and loose here. We're getting a big volume break and close below both of these key moving averages on a weekly. And at this point, my guess is if we were looking here weekly, daily, and the rally back to resistance that kind of fizzles on lighter volume, my guess is you're at least reducing a position, if not selling the whole thing. Some of, listen, if you're running a few $1 billion in the stock market, you're going to want to pay closer attention to stocks longer term moving average, possibly a 200-day. It's much harder to sell, to eliminate. It's fine to sell a partial position and try and buy some back. But at the end of the day, for us that are trading nowhere close to that, there's nothing wrong with, eliminating a stock as it breaks key moving averages here on big volume and working your way back in somewhere along the line. And as we can see, this base, it takes a while. We go from wide and loose, and we get a volume contraction pattern here. I've got arrow here. Let's clear up the mess that I've made. But you can see from here to here, we're starting to get tight again. It gives you that pennant or flaggish formation, volumes drying up, and then again we finally, after working off that run and what have you, we've got another breakout that actually doesn't really go anywhere. Ultimately gives us another, what I would tell you, base on base breakout. And so we do get another big run up out of here. I would, we've got, again, I'll point out, we've got the constructive tight action in around moving averages on light volume at the bottom of these structures. But at the end of the day, we do get another big. So what happens here as we're looking, and I think this is, for those of us who have been around at least for a little while, it didn't matter how good Google is here after this reversal. We're going into 2008 and the weight of the market and that big, correction or, overall top that we saw. That was the end of this cycle for the leaders that ran up, let's say, from that period between 04 and 08.
Absolutely. And just to reiterate the point, here we had a move from 100 to around 450, whatever that high is. And then we had a rest from basically January of 05 or January of 06, all the way until September of 06. So the stocks that run up 400%, they're going to need some time to consolidate, form another longer term base if they do so. And then once we start to see constructive tightness, the strong or the nice volume pattern here, drop on volume with tight price action, that's when we can kind of keep an eye on the stocks and potentially enter on a consolidation pivot or higher up in the base if we want to. But yeah, the very strong move from Google and a really great example of the fundamentals, technicals all lining up together. All right, so here we are now on a daily chart of Google to take a look more in depth at that first IPO base, which a lot of strong winners have. They have a very powerful move from that first stage base. So as we saw in the document, Google price at 85 opened right here. This was the low here, and then moved up to about 113 or so, pulled back only to just below 100. So a pretty tight IPO base. And then we maybe have some early entries inside day and up here. This is definitely for more advanced traders. You don't want to be putting your whole position on at this point, but then you can maybe add through here, this resistance point, and then through the standard kind of IPO base pivot right at that first high that it formed. So Ross, I guess shortly, what do you kind of look for in terms of IPO bases? And you mentioned to me earlier that you've got that kind of template built up from the greatest winners from 98, 99. So talk a little bit about that.
So I'd say the larger majority of IPOs will ultimately undercut the low of their IPO and form some kind of U-turn. Most of them create the bottom of that U-turn below the low of that IPO right here. In this particular case, as you know, Google doesn't do it. That's rare. That's showing mega strength right there. But in general, I don't really think it matters whether the U-turn, so on a relative basis, relative strength, relative to other names, relative to the market, that's fantastic. And again, with managing risk along the way, you can start buying exactly where you said and doing that, the strength alone. And you could have just used, as you see, it's very short-term 10-day moving average to keep you in the stock as you're squeezing your way in through the breakout early. But in general, and I don't want to keep going on and on, I'm really looking for some sort of U-turn. I want to wait for some, a low of some sort, whether it's in 2 weeks or 2 months, whether it's above that, IPO low or high. I'm never trying to buy it within the first few days. Let me put it to you this way. You've got to have some sort of pattern to deal with and not just, well, I'm going to buy it here and eventually I'll be right and I'll just keep stopping out for 1%. You can really make a mess doing that. You can make a mess of your account and your psychology doing that. So I would say you at least want to wait for enough of a history where you can, if you're going to play that game, you're not just putting in little stops going, oh, I believe, you're not doing it on, I feel like it has to go. There should be no emotion involved. You should be making decisions with, am I the house here? And when I say that, meaning, I often look at this game as, I don't know if you've watched the movie 21, counting cards, either the deck is hot or the deck is not hot. So I want to wait for that, so when the deck is hot, the odds are, your risk reward is in your favor. You're the house. So until I can manage risk in such a way that I feel like I have enough edge that I'm not gambling and I'm the house and I'm not buying it because it's the Google IPO and I'm excited and my emotions are affecting me, that is probably more important than where the actual low happens.
Yeah.
So
absolutely. And just to point out, because it's very clear here, you've got this first move up. So here we're avoiding it because it's too early. There's no base structure. Then it sets in this high, pulls back, and you can see how volume is declining along here. Then we have a very strong pocket pivot day here on very high volume, closing near the highs. That's your first tell to potentially look for that start of the U-turn. Then we have a next day, which doesn't look great. You can see it closes in the lower third, lower half there, but it's on much lower volume than that pocket pivot day. So that's a clue. So that's when you can try to work your way in when it starts moving up. Strong closing ranges all these days, and then it just really takes off as institutions really pour in the money and start accumulating shares. So that's kind of how to play an IPO base. Wait for that U-turn. Look for potential early entries, manage risk along the way, and make sure that you're not just diving in with no base structure. You have to wait for a proper setup. And yeah, anything to add, Ross?
No, that's it. I mean, honestly, it's, keep in mind, it's systematic, but when you get that big winner and you really, you've got that perfect blueprint in front of you, ultimately, and you're managing, you're going to catch, you don't need that many of these where the shorter term moving averages are just going to keep you in there. Right. And you have no choice but to have a huge winner as long as you keep your emotions out and risk reward always at the, that's where you should be operating from. You should never buy a stock without understanding where your stop is and why, ever.
Right.
I'll leave it there.
Yeah, perfect. That's a great spot to end it. So thank you guys all for tuning in. If you enjoyed, please go ahead and leave a like down below and subscribe if you're new to the TraderLion channel. And we'll see you guys in future videos.